Thank you so much. I'm really excited about being here. So thank you, the Ford Foundation, the Levy Institute, and Minds. So as Jan said, I'm going to kind of provide an alternative view, or a view more from the South about crisis, prevention, and crisis response. The title of Minskyan in the Pampas is kind of was the idea that Roberto Fengel and I had once when we were writing a paper for a special issue for the Cambridge Journal of Economics. It was immediately released after the global financial crisis, and so we were a little concerned that the way people were treating crisis in a good way was Minsky was brought back to the theory or analysis of crisis, but we thought that the way crises were being addressed in those days was too much US-centric, and so we wanted to tell the story about crisis view from the Pampas. So probably I should have made a different title. Since I'm in Rio, I should have said Minsky drinking a caipirinha or something like that. But for an Argentine, it's too much to do. So what I'm going to do is to try to address some differences between developed and developing countries in terms of the way crises occur in these different countries, the way governments respond to crisis, both in developing and developed countries, and also how governments try to prevent crises, both in developed and developing countries. So starting with the way crises occur. Well, here again, I think what we share, and this is, I think, exactly the same what Frank Meredoso said in his comment before in the last session. What I think we find very similar with the traditional Minskyan analysis is that we believe that people operate in an environment of fundamental uncertainty, which makes them unable to really base their decisions on exclusively optimization rules. What people usually do is to try to make some kind of calculations, thinking about the future, but of course they don't have the elements to do such a thing, so they are of course influenced by psychological aspects. And so what we observe is that people behave with animal spirits, they are very influenced by other people's decisions, and so you observe type of beauty contest or herding behaviors. And this inability of relying on deep factors to make calculations and optimize makes them behave very procyclically. When the economy is going through a boom, they are very optimistic, and so they see the future with good prospects, and they under or they misperceive the potential risk of their decisions. And on the contrary, when they are in a crisis situation or in depression situation, they look at the future with pessimistic eyes, and they overreact regarding risk. So this kind of behavior of us make capitalism follow this kind of boom and bust cycles with this kind of endogenous behavior by people. So in this regard, both probably developed and developing countries have the same kind of micro foundation, if you like. Now, the key difference, and I should have said this before, is that I think when we are here because we are concerned about financial crisis, but financial crises are important in my view because they are typically developing macroeconomic crisis. So it's is a particular industry that has some peculiarities that crises in this industry generate macroeconomic crisis. And so in a developed country, a financial crisis, typically the forces that will end up in a financial crisis develop from the financial sector itself. So you will observe that with this kind of Minskyan type of agents, which have this kind of procyclical behavior, and together with that, if you adapt to that financial innovations, you will observe that the financial sector becomes increasingly fragile. At some point, there is some bad news that triggers a crisis, and the crisis spread to the rest of the economy. So the key issue, the last panel talked about this in quite much detail, but what I want to stress here is that in developing countries, it's not the case that crisis, the origin of crisis lies in the financial sector. What you observe typically is that crises typically develop after some kind of innovation in the macroeconomic policy. If you observe the crisis in developing countries, you will observe that they were typically preceded by some kind of a new macroeconomic policy regime. And these macroeconomic policy regimes typically have three main elements. One of them is some kind of fixation of the exchange rate. The other is the opening of the capital account, and also trade liberalization. In some cases, these programs also were launched together with some kind of deregulation of the domestic financial market. And so with these three characteristics, what you observe is this kind of also an endogenous boom and bust cycle. The key issue here is that the combination of deregulation, liberalization, and fixation of the exchange rate creates arbitrage opportunities between domestic and foreign assets. And so what you observe is typically high yields in the domestic economy, so this attracts capital inflows. The capital inflows becomes into an expansion of domestic liquidity, credit, and this typically accelerates spending decisions and economic growth. Because you have the exchange rate fixed, the expansion of aggregate demand typically leads to some kind of inflation. More especially if this kind of program was launched as a strategy for this inflation, because in many cases this kind of setting was the basis for a stabilization program. So what you observe is, together with the expansion of the economy, that the real exchange rate appreciates due to non-tradable price inflation. And the consequence of real exchange rate appreciation and growth acceleration leads to a current account deficit and accumulation of foreign debt. So in the downside of the cycle, what you observe is that on the financial side, that domestic agents are typically short in foreign currency and long in domestic assets. Is basically what happens in the financial sector, in the banking sector. And a key issue is that there is no lender of last resort in foreign currency. On the real side, what you observe is that because of the real exchange rate appreciation, the economy has no tendency to generate foreign exchange through trade, right? So it depends basically, the maintenance of the fixed exchange rate typically depends on more capital inflows. So given this situation, at some point people start worrying about the exchange rate risk, and the exchange rate risk creates a deceleration of capital inflows and also the contracting forces of the cycle, because the interest rate, the domestic interest rate starts going up, liquidity starts shrinking, and as this happens, it could happen that you face a bank run or a bankruptcy of some specific applications, so you can have a banking crisis if you didn't have it before. And also, if you have a banking crisis, you probably have this, the government has to jump in and bail out the financial sector, so probably you also have public debt crisis as well. So just to give you some flavor of this, you probably know that there is like a database of crises constructed by two researchers at the IMF, which are Levy and Valencia. And so I took from their data set of crises some of the most well-known crises in macroeconomic crises in Latin America. And what you see is that basically all the financial crises were also currency crisis or balance of payment crisis. And some of them also were public debt crisis. So what in the developed countries is a macroeconomic crisis due to a financial crisis, here in developing countries, macroeconomic crises are twin or triple crisis, right? It involves the exchange rate, the financial sector, and probably the public sector as well. Here I have some, I don't know how much time do I have yet? 10 minutes left? Well, I don't think I can go through this in detail, but this is basically evidence to show you that some of the most well-known crises in Latin America basically respond to this kind of boom and bust cycle that I was mentioned before. These episodes are crises that were triggered after some disinflation program, which these three characteristics that I mentioned before: the fixation of the exchange rate, the opening of the capital account, and the trade liberalization. The first year of each case is the year in which the disinflation program was launched, and the last number is, or year is the year where the currency crisis occurs. So basically what you will see is that you don't observe public deficits being a problem. If you look at, so here what I did is to sum up the three years prior to the crisis of the fiscal balance, and the same here with the current account. I integrated so the figure here are the addition of the three previous years to the crisis. And so what you observe is that basically none of these, in most of them, there was no public deficit being a problem. The same probably with the figure of the public debt GDP ratio. So you don't observe high public debt ratios before the crisis. What you observe is that in all these three cases, the devaluations were preceded by some kind of deterioration of the current account or the external balance. You observe that all countries were overvalued. Here is an index of real exchange rate overvaluation. One meaning that the real exchange rate is in equilibrium, whatever that means. Below 1 is an overvalued exchange rate. Above 1 it would be an undervalued exchange rate. So here, because all of them are below 1, this means that all these countries have overvalued exchange rate before the crisis. what you observe is that all of the countries had current account deficits, massive, I would argue, like for instance Chile before the crisis in 1982. This is, of course, again, the accumulation of the 3 years previous to the, no, it was not 26% of the year before. No, it's the 3 years before the crisis. If you add the current account, it gives this figure. And here what you will observe is the external debt to exports ratio at the moment of at the moment that the disinflation plan was launched, and the same ratio in the year of the crisis. So what you observe is that this ratio in all cases go up, right? So so basically this is some evidence of that the external problem was the main trigger of crisis. So now let me go to the response to crisis, the difference between developed and developing countries. So again, here you will find some similar patterns between developed and developing countries. In a financial crisis, you would typically observe that the private sector has a sudden change in their portfolio towards liquidity and safe assets and against risky assets. So that's a typical behavior of the crisis. You observe a fall in most asset prices, which generates wealth loss for the private sector. You will observe typically collapse in credit, spending decisions that are postponed or cut, and basically aggregate demand, output, and employment going down, right? 5 minutes, okay. So this is basically, I mean, if you look at any crisis, financial crisis, you will observe these behaviors. Now, what I think are two key difference, or a key difference between developed and developing countries are these two characteristics. In developed countries, the preference for liquidity means preference for domestic currency, and safe havens are government bonds in developed countries, right? The other specific characteristic of developed countries is that they can issue debt in their own money. And this has very important implications, because when you have these behaviors of liquidity crunches and high demand for liquidity, the central bank is able to issue that liquidity. So the central bank is actually, well, I put here as a liquidity provider of last resort, right? That's a typical trait of a developed country's central bank. So in developed countries, you wouldn't observe liquidity crunches or bankruptcies due to illiquidity. This is something that Randy Ray was mentioning today about what happened in the US. This was very clear in the case of the quantitative easing, for instance. The another important implication is that the flight to quality or the flight to safe havens is that the government of the developed country does not face a financing constraint in the time of the crisis, so it can have a very aggressive fiscal policy at the time of the crisis. And of course, there is no possibility of default on the currency that the country issues. So, so from these three outcomes, in a crisis, in a developed country, fiscal and monetary policy can be expansive, and they are basically unconstrained. The only real constraint is politics. If you have the Tea Party in your country, well, that's probably a day constraint for these fiscal and monetary policies. Now, in a developing country, these two characteristics are quite different. The flight to quality and the preference for liquidity is preference for foreign assets, not domestic assets. And also the other trait of a developing country is that they basically they are unable to issue all their debt in their own currency. They have to issue in international currency. So they are constrained by the so-called original sin. So now the implications of this is that the central bank cannot act as a liquidity provider of last resort. Right? The government or the central bank could try to get funding in the national reserve through the IMF, but of course it's hard to explain the IMF to provide enough liquidity to do a quantitative easing or a TARP, right? So this is a major constraint. So I have to wrap up. So basically, I want to also emphasize well, this is something important that I want to emphasize. The last point that, of course, the central bank has the ability to issue its own money in this time of a crisis. But if you have people demanding foreign assets, if you just issue domestic currency, you risk the possibility of engage in a depreciation inflation spiral. So the central bank is also constrained in that regard. I think I don't have much time to talk about the differences between crisis prevention. The last panel addressed this issue quite in detail regarding the US case, the macro-prudential policies. And this is what I want to just mention in 1 second is that for the developed country view, the discussion of macro-prudential policies typically go to focus on policies that address systemic risks in the financial sector. Macro-prudential policies for a developing country go beyond that. Not only that, it's what Kevin addressed in his speech, using capital controls, but also you have to use a set of macroeconomic policies that minimize the risk of a sudden stop or a reversal of capital inflows. So in that regard, you need something that Roberto and Bresser mentioned yesterday, current account surpluses, or a macroeconomic policy that tries to aim towards running current account surpluses, non-overvalue the exchange rates, and large stocks of foreign reserves. Just my bottom line. Look the difference between what Bresser and Roberto discussed yesterday. They were basically talking about these characteristics regarding developing countries' strategy for development. The idea was to have a competitive exchange rate to promote the development of tradable activities that are key for development. Here, what I'm just saying is that the same kind of macroeconomic policy is good for macroprudential purposes. So in a way, developing countries face a kind of divine coincidence in terms of their macroeconomic policies, because trying to address macroprudential policies and development strategy demand the same kind of macroeconomic strategy. Thank you. Sorry for that.
First, let me thank the Levy Institute and Dimitri and Ford Foundation and Marco for inviting me to this year's conference. I'm delighted to be here. It's quite exciting to present about liquidity creation in Brazil and banking. So that's going to be the main topic. So for this session, I'll briefly talk about banking in Brazil, and in particular, one, perhaps the main component of banking, that is liquidity creation. But before I present, I want to talk about The conference also represents the beginning of a multi-year grant awarded by the Ford Foundation. So we have two big projects. One is finance innovation and development, the role of public banks, and that's Rogério, who's the director of the project. The other one is on financial governance banking and financial stability in Brazil, and that's the one that I am supervising. So I'd like to show you before I start my presentation, mine's website. We have a brand new website, a lot of work that people at Minds, the staff, work to put this together. So most of the materials for those projects you can find here on the website. And we have been collecting or have been doing interviews with several speakers here, and those interviews will be on the website as well, right? So I strongly recommend that keep checking the website because there's going to be lots of material there for you to explore, and the material pretty much going to be based on, it's going to be grounded on a Minskyan framework, all right? So that's the one. Partner on banking. This one originally was just one. So for Minsky, when you talk about Minsky, you tend to think about his stability theory, right? His stability, financial stability hypothesis. But most of Minsky's work is on financial regulation and banking. So we'll be looking at that aspect of Minsky's contribution. So Minsky's view of banking is quite simple in a way. Banks buy assets by issuing liabilities like any other economic unit in capitalism. You have the endogenous money creation, and that liquidity is quite endogenous. That is, during economic boom, increase liquidity in the system. And that's a quote that you'll find in Minsky. Kriegel has been emphasizing this a lot in several presentations, that banking is not money lending. Right? That is, to lend, a lender must have money, and the fundamental banking activity is accepting that is guaranteed that some part is credit worthy, right? So that's going to be the guiding principle for banking. Now, what is the main component of Minsky in this context? That is, over time, you have dynamic change in the nature of banking. That is, in particular, if you look at the Brazilian economy, they have a sharp decline in the interest rate. Right? That's going to trigger internal change the way that banks conduct business. So for Brazil, if you map the decline in the interest rate and treasury securities as a share of total assets for banks, you have a sharp decline for the past 10 years. Right? And that was something that Minsky already anticipated. That is, over time, you tend to shift your portfolio towards liquid instruments when you start to receive lower return on other assets. So here shows the same thing, but look at banks' balance sheet in Brazil. So you have a sharp decline in liquid securities, treasury securities on banks' balance sheet, and then you have here for the brown one, you have the increase on credit on claims on the private sector, right? That is, the banking sector as a whole is shifting towards more liquid instruments. And that's going to be important for us in terms of to understand what banks are doing. So here's a brief overview of the Brazilian financial system for the ones who are not familiar with the Brazilian financial system. You have here public banks, in particular Bank of Brazil. You have 24% of credit operations share as 24% of Bank of Brazil as a total share of credit operations, right? So the public bank here, and then private banks are responsible for 37% of total credit operations, right? And then you have foreign banks for almost 20%, right? Just to give an overall picture, have a mixed financial system, both public and private, and public banks play an important role. So, to look at the housing financial system, in Brazil there's a big discussion about funding. That is, as you all know, most Brazilians tend to say that the lack of long-term funding facilities is a constraint to bring about more investment. Right? So if you look at the housing system, financial system in particular, this system has some specific rules. So under this system, the housing finance system, for all saving deposits that you have, banks, they have to lend 65% on average against those saving deposits. Right? And most Brazilians, most economists, orthodox economists for the most part, they tend to think that saving deposits are financing mortgage loans. Right? That's the orthodox, as you all know, explanation. But here the idea is that we have minimum lending requirements. Right? So look at banks' balance sheet on the liability side, 65% of that they have to lend to against mortgage loans. Okay?
Now, the point here is that if you're under that system, there's a cap, there is a ceiling that you can charge on mortgage loans, right? And that's about 12% plus. Okay? So if banks decide to be under that system, or if they operate under that system, they cannot charge more than 12% plus TRs, the interest rate that we have here. Okay, so that's the limit. Now, the idea is that in the late 1990s, we lacked the resources to develop housing in Brazil, right? The idea is that we have a big housing gap. And at that point, to overcome that housing gap, they told us to replicate the US financial system. And remember, the US economy at that point was booming, right? So in the late 1990s, regulators and policymakers, they came up with reforms to pretty much replicate the US financial system, right? The housing sector, at least. Now, those reforms implemented in the 1990s, early 2000s, pretty much what they're doing is to break banks' monopoly on liquidity creation, right? That is now have new instruments that now are called the real estate financial system, right? And under that system, that are supposed to complement the existing housing finance system. For that system, we can issue asset-backed securities and mortgage-backed securities, for example, right? So it's a clear attempt to try to replicate that market. So what we're doing here is to break banks' monopoly on liquidity creation. Now, the point is that in spite of that change in reforms that we had, that system failed. That is at least what they were intended to do, that was to foster mortgage lending. That didn't happen. Instead, most banks, most financial institutions were using that system to move assets off their balance sheets using asset-backed securities transactions. They are not still as developed as in the US, but you still can use a basic ABS transaction under this system, right? And that was precisely what banks did. They were securitizing auto loans, credit card loans, and payroll loans, for example, right? So that was the segment that increased, securitization market that increased in Brazil. And remember, the original idea here was try to develop the housing market. But then you are actually moving assets that have nothing to do with the original idea of the proposal. Now, what is the assumption here? The assumption is that on one side you have economists saying they have lack of savings. So it's important to come up with a financial design that can capture those savings to promote development. Now, my point is that actually what we have in Brazil is a shift in their portfolio preferences towards short-term assets, right? In particular, low-duration assets, and there's a reason for that, and I will show why that's the case. The IMF in 2012 released a report saying Brazil is still stuck in a high interest rate, low-duration equilibrium, right? But they couldn't come up with a good explanation for that. Well, it's not that difficult to understand. If you look at the loans portfolio for Brazilian banks, on average, it was about 30%, right, the loan portfolio. Now, remember, if you are working under the house finance system, there is a cap, so banks can only charge up to 12% on those loans, right? So here, what you're saying is that banks can get way more, or they get more returns on other loan products relative to mortgage lending. And mortgage lending in particular is quite expensive, right? All the operational costs that you have associated. So banks never had an incentive to go to that market, to the mortgage lending market, and explore, right? You can rely on short-term assets, get really nice returns, given the funding costs. And if you compare Brazil here in terms of net interest margins, it has been declining due to several efforts to reduce loan spreads, but that also is following the declining interest rates that we have in Brazil. So here, for this line, I have for Brazilian banks, net interest margin for the early 2000s equal to 6.56. You cannot even find that in any other system in the world. Quite high returns. And also, that's also hiding high operational costs. That's something that Brazilian banks still have to face in the near future. Right? So far, operational costs have not been an issue, but most banks now are working on that, on trying to reduce their operational costs, trying to be more efficient, to be more competitive. So you get really high return on equity for Brazilian banks in an environment that you have really low leverage. Right? You compare Brazilian banks, and that's the green line over there, you have quite low leverage. So you get low leverage, really high returns, given the return on assets that you have. So there's no reason to be exposed to long-term assets. Now, let's look at why banks don't do that. Why, one, banks don't have the incentive to move towards long-term assets. And let's see what happens if they decide to do so in the environment that we have in Brazil, in the macro environment that we have in Brazil. This is Setúbal, the CEO of Itaú Unibanco, who's the largest private bank in Brazil. And then he was saying the following: look, mortgage funding will need to be developed in Brazil, but in a different way. We will not be financing long-term assets with short-term deposits in the way it was done elsewhere in the world, particularly in the United States, with thrifts in the United States and savings and loans. Okay. That is, bankers are not willing to be exposed to long-term assets, and in particular interest rate risk. So let's see now that you have a change for most short-term assets. There's a sharp decline on the return that they can get. So now banks are trying to increase the duration of their portfolio, right? To try to increase their returns as well. So what's happened is that at the same time that they try to increase the duration of the portfolio, they're trying to increase the duration of its liabilities as well, right? That is, to maintain the same duration gap, or at least to try to keep between some range for the duration gap and then manage your interest rate risk. They're not willing to increase that range. And remember, in the US, we have, for the ones who are familiar with the US financial system, most savings and loans will finance 30-year mortgage products with short-term deposits, right? So that kind of financial system requires stable interest rates, right? And that was precisely the Volcker experiment in the early 1980s that killed savings and loans in the United States. And Brazilian bankers are not willing to do that, to be exposed to that risk. So, policymakers and regulators are working on that direction. That is, there's a need now to be exposed to long-term assets, and now they're creating new instruments, long-term instruments to do that. There's a sharp increase on banks' total assets, more than doubled for the past 6 years, but they did that mainly by relying on short-term assets. That's the liability structure. There's an attempt now to increase that the brown area is the one that we have for assets that we can separatize, creditor rights. Okay, so for that upper portion there. Now, then what should we be doing to characterize financial systems, right? Usually we look at bank-based and capital-based financial systems. Now, the point is here is that what we should be doing is to look at the institutions who are willing to bear the risk. In Brazil, banks are not willing to do that. They will not assume that risk on their balance sheets, right? And that brings to a paper that Krieger wrote in 1993. That is, he was saying that rather than characterizing financial systems as market-based or bank-based, what we should be doing is to distinguish between the risks that are carried on the balance sheets of banks and other financial institutions. Right? So let's try to do that. Let's try to understand the portfolio preferences of different institutions in Brazil. So for the first one, what you get, you have financial institutions. Here, mainly banks, and then mutual funds. Here, pension funds, and then insurance companies. The blue area up to 1 year. The yellow one from 1 to 3 years in terms of the maturity for portfolio. Right? So not only have a preference for government securities that receive really high returns, but also really short-term ones. And almost all of them are doing the same thing. Right? Now, for the ones who follow the reports that both Bradesco, Unibanco, and Santander released during the second quarter of 2013, they had a really hard time to explain to investors why they had to report almost $12 billion in losses. And during that conference call, they had to say, look, we had on our balance sheet, due to our asset liability management strategy, long-term bonds, right? Such as NTBs. NTBs are treasury securities that will have long-term aspects. Now, for those bonds that they had in their portfolio, given the change that we have in the yield curve during the first semester, right? A sharp change in the yield curve, then due to market-to-market accounting, they had to report those losses. So all of them combined, those losses are equal to $12 billion, 12 billion reais. Now, the point is that in a high and volatile interest rate environment, there's no way to try to develop a long-term asset market. It's extremely difficult to hedge that. Because even if you try to hedge that operation, somebody else in the system has to bear that risk. And most financial institutions in Brazil are not willing to do that. Right? So the point here is to look at the duration exposure of each financial institution. Now, and then we look at mutual funds, because many economists in Brazil are saying that one option is to look at mutual funds and make them invest in long-term assets. And if you compare the mutual funds in Brazil and the US, the UK, and China, and India, for example, right? Even mutual funds in Brazil, they have a preference for corporate bonds. The equity that they have in their portfolio is quite small compared to their international peers. Now, and the size of the industry is quite large, right? So if you look at the mutual fund industry in Brazil, right, the mutual fund assets relative to GDP, in Brazil is almost 50%, right? So that's quite high. The portfolio that you have for them, if you can come up with ways to force them to invest long-term assets, but to do this, you have to make sure that you have a stable interest rate environment, or at least try to come up with ways to reduce the interest rate risk, then you can come up with ways to finance long-term assets. So these now to look at also the mutual funds, and then a portfolio allocation from 2011 to 2012. And then we have government bonds and corporate bonds now have an increasing share for the private fixed income market in Brazil, but in terms of equity, it's still quite small. Another potential source of risk that we have for mutual funds in particular, and that's something else that we'll not talk today, that's going to be another talk, is the repo exposure of mutual funds, or that at least that banks have to mutual funds. So for repo transactions, you have almost 25% right, of total assets. And that's an important source of liquidity creation in the Brazilian financial system. That's it. Thank you.
But mainly a market for long-term private bonds, because at the end, apparently, on the one hand, you have the problem related to the interest rate instability, but on the other hand, it seems that the lack of long-term corporate bonds market in Brazil is something that is also basically in this scenario that you presented.
Felipe, I want to ask you, what are the consequences of this? You showed, the big banks, they have this massive loss in the second quarter, and part of it is because they bet on an environment that they thought would be staying, which is the lowest interest rate that we saw in Brazil last year, and then the result is that interest rates are going up, and the provisions that they're going to continue going up. So what is the consequence of that in the behavior of the banks? Because if I see what you presented, my conclusion is that Brazil will never have banks betting on long-term assets after those losses. I mean, they got burned, right?
There's a joke I used to make that the Selic is the Bolsa Familia of the elites in Brazil. Well, Rogério asked about the BNDES. We have the government at one side giving for there are two parts in finance. There's one part that's giving the money. This part doesn't want, they just want to have a kind of reward for having the money to pay for their pensioners, for their pockets, stuff like this. And there's the part that wants to finance to invest. Well, perhaps Brazil has a kind of way that the states separated these things. We have the long-term finance in one kind of instruments that states provide, and the part that gives the money to the pension funds, to the people that has live to the rentists in another part. Yeah. Just place this. Maybe it's a different way to make this kind of operation.
It's about the fixed income market, the private one. When you compare the U.S. capital market, for example, when we go back to the 50s, 60s, and 70s, the development of the commercial paper market in particular was an attempt to get cheaper funding for corporations. Right? At that point, it was cheaper for them to go to the commercial paper market rather than going to banks. Right? And that was the period in which have the beginning of the development of the shadow banking system in the United States. At that point, traditional banks in the U.S., under the Glass-Steagall rule, they're receiving pressures on the liability side, right, due to change in interest rates that were above regulation Q. And on the asset side, the commercial paper market, right? So banks were suffering that pressure, and it was cheaper for firms to do that. That doesn't mean that banks couldn't do it. So it's quite expensive for them to do that if they decide to go to banks and get the money, right? So it's not necessarily in terms of the ability to do it, but it's a relative price that they have to pay, right? And that's one of the beginnings of the shadow banking system. So I would rather prefer to see a system in which you have a controlled banking system, right? If that is going to be efficient in a way that you have credit that's not expensive and can be done using the kind of regulation that we have, rather than developing a capital market that's going to be outside the traditional banking sector. Right? It didn't work in the United States, and we are trying to replicate that model as a basis for development. It's not going to work. And again, when we talk about the shadow banking system, and in the 2000s, have Paul Macaulay that coined the term, right? That developed in the 1960s and 70s, right? Money market mutual funds was in 1971. That is what Minskyan was saying, that have the long-term evolution of the U.S. financial system. It takes time. So all those changes that are seen in the Brazilian financial system, they will take time to take place, right? But we in Brazil have all the components that can bring about the development of those alternative liquidity creators in the Brazilian financial system. So that's one. So for BNDES, my position is quite simple. I would rather increase the capitalization of BNDES via fiscal operations, right? Finance the long-term development of the Brazilian economy, and do that through the public banking system. But private bankers, they're not willing to do it, right? You look at all the reports, you look at the reports of all private banks, they're not willing to expose themselves to long-term assets. And even investment banking activities in Brazil are quite small, right? Many who have a universal banking system, but commercial bank activities are the segment that get most of their returns, right? So you have to give them the chance to do it. I'll do it via BNDES and the Treasury, finance innovation, and promoting development policies. So that'll be the one. For your question, was not necessarily a bet, because during the conference call, an analyst from JP Morgan, Credit Suisse, they asked the same question. What did you do? That was part of proprietary trading, betting on changing interest rates, or was part of asset liability management? And the CEOs were quite clear, at least that's what they said, that that was part of asset liability management that they had, right? Many in particular to cover saving deposits and subordinated debt, right? So they said, look, they don't represent economic losses because due to mark-to-market accounting, they have to do that. So there's quite the structure of equity capital, but they said, look, the way that the Brazilian regulators classify that, you have securities available for sale. If you have securities under that category, and if you hold those securities until maturity, then you get the full principal, right, when that bond matures. So don't get losses. You just get capital losses due to interest rate fluctuations. And that they said it was part of asset liability management for that, not necessarily betting on the movement because they don't need to do that at this point, right? The return on other assets are way higher, and they don't need to do that to increase their returns, but at least at this moment.
It might be a good idea to change the way you do market on your fixed income portfolios. Okay.
My question is for Martin. So as far as I understand, what you mean is, so what determines financial fragility is not the banking system or the financial system in general in Latin America, but the current account deficit, what creates the probability of the crisis. But the magnitude of the crisis, still, given that the effects all go through credit and aggregate demand and so on, as in the developed countries, I guess, would have the same determinants, or, I mean, how bad it is, I guess, is still very close to the US or any type of banking crisis that Minskyan described, or is it not?
One question for Martin, and it's basically a friendly amendment, but I was wondering whether we should still distinguish between developing and developed countries, and rather than say, do countries have their own currency, yes or no, and are they exposed to foreign debt, yes or no? Because after the euro crisis, I think that has changed. And then for Felipe, a question, I think we have to put on the table also the discussion about competitiveness in the financial system. Because I think, one of the reasons you suggest some banks won't do this, expose themselves to long term, because the others will make more money if they do the short term thing. And of course, that is part of the story that we've seen over the last 15 years. We've incredibly increased the competitiveness of financial intermediation and broken down the barriers between different segments of the financial markets. And maybe one way to think about this is not only, to erect barriers between public and private, but also to rethink the notion of competitiveness in financial market. I know it's heresy for economists, but I'd like to put it on the table.
That's a low share of investment in GDP. It seems to me that on the international side, the borrowing that happens and it comes from the need to finance a current account deficit that may not be involved in investment goods. So I'm just curious about that in the investment relevance of the financing that's cross-border. But then for Felipe, I don't know how BNDES can have the scale influence on the share of investment in GDP that's needed to get Brazil growing faster. And so it seems that this whole mobilization of capital for productive investments is just wholly inadequate. What could be done, or what explains that? And those are just my concerns.
My last point, I completely agree with you. I mean, we should use your classification. Actually, I think the one who the first pointed to this was a paper by Paul de Gros that makes the point very clear. I completely agree with your point. To Laura's point, no. First, I think if we focus on crisis as what I call macroeconomic crisis, maybe you can have, in the experience of Latin America at least, you can have a crisis without financial crisis. Or if you define crisis as an important drop on GDP or economic activity. But regarding the specific of your question, I think the key point is that in developing countries or in countries that they don't issue their own with original sin, let's say, to simplify, financial crises were related to the way the economy, the domestic economy, integrated to the rest of the world. So in that regard, it's key how its external accounts behave during the cycle, right? So you have to be prepared to moderate or alleviate sudden changes in portfolio decisions towards external assets. So in that regard, I think that's the specific of original sin countries.
To Catherine's question, I do agree that banks in Brazil, competition is a problem, and they enjoy a really nice monopoly. That's the monopoly, the liquidity creation monopoly that I was mentioning before. But if you look at the U.S. experience, and I'm pretty sure if you look at other financial systems, you'll find the same pattern. That is, if you try to stimulate competition, encourage competition in banking, particularly in liquidity creation, that's quite dangerous.
Well, I was saying the opposite. We want to reduce competition.
Right. Yeah, but in terms of liquidity creation, to have other institutions to do it, that's quite dangerous. So the attempt to break that monopoly by bringing others, and in Brazil in particular, have regulatory powers to just make them more efficient, right? So Brazilian authorities just use public banks to reduce those spreads, right? I was talking to several of my friends here who live in the US or in Europe or abroad, anywhere in the world. You talk about bank spreads, they're always surprised to know that for credit card loans, what you get on average, 238% per year. That's the APR in Brazil, right? If for subprime consumer in the US, the subprime rate would be equal to 29%. When I was a grad student at UMKC, it had several companies sending me credit card offers, and that was equal to 25%. And that was the subprime rate. I didn't have any credit history at that point. So in Brazil, it's 238. So can use the powers that Brazilian regulators enjoy to do that, right? We kind of did it. That was the first step, but we stopped the full implementation of that option. It would be really important to follow that and use public banks to reduce those spreads. So rather move in that direction. For Hobart, your question is that the BNDES might not have the scale to finance Brazil's investment needs. I disagree for two reasons. One, you can do two things. Increase capitalization of BNDES via fiscal operations, as they did for the past 5 years, right? So that's one thing. And finance innovation, finance development. And get the priorities, right? And finance those investment opportunities. Our finance minister was in New York begging international investors to invest in Brazil. We had a concessions program, right? They were asking international investors to invest in Brazil. But what I would say the other, to complement that, to complement BNDES, I would go fiscal, use fiscal policy. Esther was here presenting yesterday the share of government, the federal government investment on infrastructure as a share of GDP. I don't know if you've paid attention to that, but that was equal to 0.9% by the federal government. Most of the investment being done now in Brazil is done by the Brazilian oil company, state-owned company, Petrobras. And that's mainly by issuing debt, external debt, right? So in that case, to meet Brazilians' investment needs, it's about $240 billion. That's a number that the government provided. I'd rather use fiscal policy. I'd get the priorities in terms of railroads, airport investment, and just do it. And don't rely on private markets to do it. You have the opportunity to do it. You can do it via BNDES if private agents are willing to do it. But I'd rather use fiscal policy. Our president was on our Wall Street Journal, Valor Econômico, saying that Brazil is at least a century behind in terms of railroad development. A century, right? So why wait private investors to do it?
But you don't have the tax base, do you? Or is,
well, Brazil, and that's another question of sovereignty. If solvency is an issue in Brazil, affordability, and affordability is not an issue for the federal government. You can finance anything that's for sale on the domestic currency. So you can use fiscal policy in Brazil. We have a non-convertible currency in Brazil. A non-convertible currency since 1999, right? That's the way that the government spends, by issuing IOUs. So solvency is not an issue. Now, the relevant issue here is to look at the impact of that deficit on real resources. And that should be something the Brazilian government should do. Brazil has several committees on development, socio-economic development that we have. It should have a committee to analyze the impacts of fiscal policy on the economy and to look at the resources. So I'd rather do that because solvency is not a problem for the Brazilian economy.
But we're talking about 20 percentage points of GDP. If you want to go from 17 or something up to 37.
Yeah, right now it's between 19 and 20. It would be 6.
That's in real terms, which is not the right way to do it.
So we have an idea in terms of interest payments. We have on average 4 to 5% of the Brazilian GDP, and we do it 6%.
Martin's presentation and the discussion about Brazil and the rest of Latin America. With respect to crisis, really Brazil is rather an exception of crisis in the rest of emerging markets. Brazil never have financial crisis. For instance, in the debt crisis of the '82, Brazil didn't have financial crisis. It was a balance payment crisis, a public debt crisis.
Because
Neither
we sterilized.
exchange rate. It wasn't an exchange rate crisis because it was an index exchange rate depreciated in real terms. So the same in 1998. There was a balance of payment crisis and an exchange crisis, exchange rate crisis, but not a financial crisis. So there was a financial crisis in 1995, but because of the effects of the real plan of the financial system and some influence of the contagion of the Mexican crisis, but it was different from the other. So I think it's difficult for the Brazilian economists and professors to teach about crisis because they have no deep experience of crisis in this country.
Sure, it's easy for you guys.
Yeah, for us, we have 3 market crises.
No, it's very well. It's not easy to prevent them,
That's a serious learning.
Not that easy. You see,
You still haven't learned how to
always
prevent.
Excellent panel.
find the same stone.
Really rich
3
presentations.
times.
I just have a comment to link something from yesterday to today for Martin Rapetti's. Obviously, in the Minsky application to developing country crises, right, absolutely right on. And in every one of the cases that you show, they were all had fixed exchange rates. But just to bring stuff we were talking about yesterday to today, then you could also have a financial crisis with those same movements. Or at least lots of turbulence in a situation with the float. Just to add that, if you look at Indonesia and India over the past 3 years, India just sent out they're going into all the Hindu temples to find out how much gold is out there because they don't have the reserves and they've got a floating exchange rate, but there was capital flight with the taper, and they're in a pinch, and so. All of your cases were fixes, but if you wanted to sort of generalize the Minsky model for a developing country, I don't think you'd have to specify that it's only in a fix.
Only comments,
I agree with you. I mean, this,
Friendly.
I mean, probably this is more of a historical look. What I did is just economic history here, and of course things change. I mean, in the cases you mentioned that I don't know in detail, I think that it's essentially the same evolution and the same problem of integration of domestic market with external financial markets and the sudden shift towards foreign assets and against domestic assets. So the fixed exchange rate.
Crisis in India.
Not yet.
Yeah. Well,
Not yet.
that's the point.
Yeah.
Because no, flexible exchange rate is a preventive measure.
Yeah, but it's there might not be a
Let's see
crisis.
what happened in India. It's just and Brazil and Argentina.
No, but
It's just beginning the new
But
phase.
I agree with Kevin that in principle it can happen with floating exchange rate, and that's true.
And it slows down the growth process in the innovation.
The thing with I think my take on the case of fixed exchange rate is that people tend to undermine the exchange rate risk when you have a fixed exchange rate, and makes the adjustment all of the sudden, the impact on balance sheets it's incredibly high. While if you have a gradual depreciation, that operates as a sort of buffer for I mean, in like trying to bridge Roberto's point and yours, of course, flexible exchange rate, I think ameliorate the chances of this kind of crisis, but they can happen as you mentioned, and I agree with that.
I don't want to ask a question, I just want to comment.
I found.
You have to ask a question, right?
Okay. I won't make a comment.
You can ask me where to buy good food in Argentina and make your comment.
What about some students?
No, look, it's very striking, Martin's table, that the characteristic of all these Latin American crises has been a current account deficit. And in most of these countries, there wasn't very much investment, and there wasn't such a high rate of debt to GDP or private debt to GDP, although that is not true. For the Horn of Latin America at the beginning of the 80s, the debt was high. The investment wasn't high. But it's all very un-Minskyan, in the sense that Minsky thought about the endogeneity of financial fragility and ultimate instability coming about because of high investment that was very high debt dependent. And it was the combination of those two that led to the financial fragility in the Minsky moment. So Latin America really is very, very different from a Minsky model. But if you look at Asia, where you have very, very high investment and very, very high debt financing of the investment, then that looks very, and oftentimes no current account deficit, but a crisis, that looks very Minskyan. So the emerging world has been very, very different, and in some cases, some variants of Minsky models seem to be very relevant, in other cases much less so, but I just think that your table sort of suggests that what Laura said, it's really been about balance of payments crises as opposed to Minsky financial crisis.
I couldn't say anything, but I really don't think that's correct. Because the point that Martin was making is that all of these things came out of structural adjustment policies. And basically, it was the structural adjustment policies that caused the crisis rather than... Felipe, you want to say something?
Yeah, just a comment on that.
Microphone.
There have been done a great deal of work on using Minskyan international context, in particular for the Brazilian economy, the East Asian economies, and Latin American economies as well. And for example, mentioned Professor Kregel has published papers on that, on Minsky, not in terms of the financial stability hypothesis, because we have a different kind of economy and its structure as well, but using Minsky in an international context and in terms of international imbalances. That was done before, and that we can characterize those crises as a Minskyan crisis using that framework at the international level. So, but not the typical in terms of the endogenous stability for the domestic economy in terms of credit, but in an international context.
Bert, you wanted to say something?
It's a completely un-Brazilian focus.
I'm just still really puzzled about how the financial system functions and where the shortcomings are to keep such a low rate of investment in GDP. I mean, it's a glaring failure of the financial system, including the public financial system. And in talking to you all, I just run into barriers to solving that problem. And yet the barriers don't really quite make sense to me in terms of solutions that I've seen in Asia that are so effective. And so putting everything on budget, that's very IMF or very World Bank, but it's just usually too hard to finance. There isn't that much money there. And it can be quite inflationary if you're going to have an accommodating central bank with 10% or more of GDP increases in a budget to spend on railroads and so forth. I mean, if you can get it from savings, divert it from other uses somehow, you maybe avoid some of that inflation. But I'm just puzzled. It's something that I can't, maybe I should try to learn a Latin language and then the way of thinking would come to me. But I wonder if you could just try to help me a little bit more about why BNDES is so limited, or why it can't stimulate more spending from retained earnings, which is really the driver in East Asia. But it is stimulated by public investment that gives confidence that there will be demand in the future for private products. and yet I don't seem to see how that could work here, and I'm just really a fish out of water in Latin America.
I didn't have the time to show in terms of how firms finance their capital assets, right? You have a combination of equity, internal funds, and debt, right? But in Brazil, in particular, it's a very simple lesson that Keynes, and I always remember that in the case of Brazilian economy, for real productive assets to get produced, they have to beat the return on money, right?
Or the expectation of return.
So you have to have the rate of return on those assets higher than what you can get on money. So I think that the finance component, right, would be on the supply side, or the supply price, right? So if you look at Keynes' investment decision, you have the demand price, and for the demand price you have your prospective earning capacity for a given investment project. And in Brazil that's difficult as well because you have to come up with source of demand that will bring about that change in investment. Remember for the presentation of China, we had consumption growing and investment was growing faster than consumption, but consumption was growing as well. And that gives the investor the opportunity to invest because he or she knows they're going to have future demand. So you have that component on the demand price. And I think what's really important that the Brazilian government, they implemented policies to precisely stimulate domestic consumption, right? And that was important in the case of Brazil. Now, on the supply side, we can talk about BNDES and other rates. So if you go to traditional banks, that's quite expensive. They don't do it. Most firms go to traditional banks mainly to finance their working capital needs, right? Not to finance long-term funds. They usually go to BNDES or they use retaining earnings, right? So that's one option. So I think that we have to provide conditions to support domestic demand and use the government. Most investors in Brazil are not willing to do it. You can get really high returns on liquid assets. Why would you bother to buy liquid assets in this kind of environment? So I think it's really important to have first, and that was one of the dynamic change, and that's happened in the Brazilian economy. If you look at the real interest rate in Brazil, it's quite low compared to our historical standards, quite low. And most pension funds, look at the pension funds returns this year. They're having a really hard time to come up with positive returns in this environment, right?
In the high interest rate environment.
In this, no. Now we have a low interest rate environment in Brazil, due to the reduction. Relatively speaking, you have, this.
Credit card.
No, that credit cards, I'm talking about our Fed funds rate.
Yeah.
The equivalent of our Fed funds rate, the real rate, is something between 2 and 3 and 5%, right? And that kind of environment is triggering change in institutional investors, the way that they behave, in particular pension funds and insurance companies, right? So that's one of the conditions that you have to come up with more investment, but that's not a sufficient condition, right? Because that will be the supply price of the investment decision. You also have to come up with more demand. And in that case, it would be mainly via fiscal policy to support that demand.
Martin,
Yeah.
comment.
Yeah, I want to comment on
Frank's comment.
Frank's comment. No, just quick comment. First, I'm not completely sure that I disagree with the point you make that the investment does not play any role in this kind of crisis. Surely none of these Latin American countries reached an investment rate as high as in Asia. But if you look at what happened with investment during the booming phases, that investment accelerated by twice as much, at least, as GDP, for instance, in many cases. So what I'm saying is that investment accelerated. And then it's a more general comment on whether this is a Minskyan or not a Minskyan cycle. In a way, I think that there are as many Minsky as readers, in the sense that some people pick some aspect of Minsky's work, or that happens probably with any work. But what I think is relevant for me, or what for me as a reader of Minsky is relevant for this kind of story, is at least two points. One is the one you made in your comment in the section before, that he provides us of a micro foundation, of a way of describing human decisions and human actions in the face of uncertainty, which I think is essential to describe a crisis. Of course, this is not only Minsky, but it's case. And the other aspect that I find in Minsky's work that shed light on this kind of crisis is that this kind of endogenous movement, when the probably in a developed country Minskyan crisis, you have some innovation in the financial system that kind of triggers the boom you face. Here is an innovation in the macroeconomic policy regime that sets in motion or plants the seeds of its own destruction, which I think is in Minsky's story. So maybe it's not Minsky for you, but it is in a way for me as a Minsky reader, right?